You've mastered patterns and indicators. But the truth is, 90% of long-term trading success is not analysis, it's risk management. Today, we build the foundation of discipline, the 1% rule and the position sizing formula. Important discipline warning. This is the boring part, but it's the most profitable part. Never risk more than you are comfortable losing. This is for entertainment and education only. Rule number 1, the 1% rule, capital risk. The most important rule in trading: never risk more than 1% of your total trading capital on a single trade. This is your safety net. If you have a $10,000 account, your maximum loss on any one trade is $100. This protects you from emotional decisions and catastrophic drawdowns. Rule number 2, defining risk, the stop loss. Your risk isn't the whole investment. It's the difference between your entry price and your stop loss price. You must define your stop loss first using your chart patterns. If you enter a double bottom trade at $100 and the pattern's low is $99, your risk per share is $1. The formula, calculating position size. This is the math that determines how many shares or contracts you buy. Position size equals total risk per share. Example, total risk is $100. Risk per share is $1. Your position size is 100 shares. You buy 100 shares at $100. If the price hits your $99 stop loss, you lose exactly $100. The power of compounding risk. What if your risk per share is only 50 cents? Your position size doubles to 200 shares. If your risk is $2, your position size halves to 50 shares. The 1% rule remains constant. Rule number 3, the risk-to-reward ratio, R. Never enter a trade unless your potential reward is at least twice your potential risk. This is the 1-2 ratio. If you risk $100, your target profit must be at least $200. This means you only need to be right 34% of the time to break even. This is how losing traders still make money. Putting it together, the RR check. If your target profit on the $100 trade is only $150, the RR is 1.5. Do not take the trade. Wait for a pattern that offers a larger measured move. Final tip, don't move your stop loss. Once your stop loss is set based on technical analysis and position size, never move it farther away from your entry. You can move it closer or move it to break even, but never widen your risk mid-trade. Mastering risk management is the true secret to consistency. It allows you to survive the inevitable losses and capitalize on your winners. What is the highest risk percentage you've ever used in a single trade? Let us know in the comments. Subscribe to Weather Finance for our next series on trading psychology.